Let me now bring on board Bhanu Baveja, Global Head of Emerging Currency Strategy with UBS. Bhanu, good morning. Thank you for joining us. Bhanu, globally, since most central bankers currently are following a loose monetary policy, some would argue that developed markets are, or there is a currency war between developed market currencies.
There isn't currency war. I think there's more rhetoric than reality to it. I think what many G7 central banks are doing legitimately is trying to boost domestic demand, and the way they're trying to boost domestic demand is by keeping monetary and fiscal policies as loose as they can. And that obviously has an impact on the currency, but with the exception perhaps of the SNB, the Swiss National Bank, there aren't many central banks in the developed world that are aggressively buying FX reserves with a view to keeping currencies weak. Many emerging markets central banks do that, of course, but that's not new. They've done that for the last 10-15 years. Historically, stable currencies in EM have been an anchor for policy. So that's not new. So the currency war certainly isn't upon us. In fact, if anything, the news is that FX reserve accumulation in emerging markets has slowed. And again, that's not because of a policy change. That's simply because there's lesser total money coming in. There's portfolio inflows coming in, as we discussed earlier, into the equity market and the bond market. But against that, the trade surpluses, the current account surpluses in EM are much smaller. So I disagree with the currency war rhetoric on two different levels. Number one, I think as Ben Bernanke mentioned in his Frankfurt speech in 2010, policymakers in the developed world will do everything to boost their own economy.
Right, but Bhanu, you expect central banks worldwide to continue to follow easy monetary policy as growth is likely to return in 2013. Could there be reason to shift to tightening then?
Very selective. I mean, you just asked me a question about planet Earth, which is difficult to answer. So in certain countries, the answer is obviously yes, there would be reason to tighten. But in the vast majority, I'd be very surprised if we moved towards aggressive tightening. What is absolutely true is that the big disinflation is perhaps behind us. Even in 2012, we saw aggressively lower year-on-year CPI rates, not just in the developed world, but also the emerging market world, and that meant a big grab for duration. Long end rates came off substantially. Today, I think that CPI levels have probably troughed the world over. But that doesn't mean that a huge rise is imminent. In fact, core inflation has been stable for the last 12 to 15 months, and I expect it to remain stable in the coming few months, because aggregate demand is not improving. You're absolutely right to say demand is improving at the margin, but global growth is perhaps going to grow from 3% to 3.4%. So really not much to write home about. I don't think central banks are going to tighten aggressively in 2013. I think this is probably more 2014, 2015.
What are your thoughts on Indian rupee at a time when the current account deficit is sitting at a new historic high? Do you think rupee will remain under pressure?
You're absolutely right. It doesn't. It doesn't bode well for the rupee at all. But the current account deficit has been high for exactly the wrong reasons. I mean, we don't mind current account deficits being high. We don't mind a deficit at all. What does a deficit mean? It means that an economy is investing more than it's saving. That's fine. But if an economy is investing more than it's saving because it's investing a lot, there may be some potential future gain. However, if an economy is investing more than it's saving, not because it's investing a lot, but because it's saving very little, then there's a problem, and that's exactly where India is. So not only is it a current account deficit, it's a current account deficit within an environment of lower investment, and that's much more worrisome.
Right, Bhanu, a whole lot of weakness coming in for the currency of late. What's your outlook for the Indian rupee in 2013, and do you expect strong fund flows to continue?
Fund flows have already been very strong. I'd be surprised if they continue at the same pace. For instance, last year was a very strong year. I think we saw about 21 billion in the equity market. So far this year, in the first month and a half, we've already seen 1/3 of that again. So, no, I do not expect fund flows to continue at this pace. I do think that the rupee is going to weaken this year. I think there's a very strong probability that India is going to get downgraded this year, and the rupee underperforms the forwards, probably goes towards 57, 58, and might head towards 60 at some point.
On Reserve Bank of India has been maintaining that there is limited room for rate reduction. How much reduction are you penciling in for, from Reserve Bank of India for in 2013?
We're looking for another 75 basis points over the course, spread over the course of the next 12 months. I do think the RBI is absolutely right to say that there's limited room because inflation in India is structural. It's driven by the supply curve. It's not an aggregate demand move. And I think the RBI is doing exactly the right thing. Many people are bemoaning the RBI and saying that they should be taking rates much lower. I think that they're being myopic. If the RBI was to take rates much lower, there is a chance that inflation becomes unanchored, which would be penny-wise pound foolish, which would mean that in the medium term, savings and investment all come lower from already low levels, and that won't be great. So I think the RBI is being conservative for the right reasons. The problem with India's inflation is not loose monetary policy. The problem with India, the root cause, the genesis of India's inflation lies in a perfectly or a near inelastic supply curve. You need to boost productivity in the agriculture sector. You need to boost productivity and infrastructure spend in the manufacturing sector. You need to free up capital in the economy by removing subsidies, by stop boosting consumption and incentivizing savings. All of this is much easier said than done, but that's the real cause for inflation in India.
All right, Bhanu, appreciate your time and thank you for your insights.